Now let's get a look at the bigger picture. Timothy Chubb's with us, CIO, Gerard, Division of Univest Wealth. Good to see you, Timothy. Your thoughts on this week that was, but more importantly, how it shapes for the rest of the year.
Yeah, sure. It's great to be back. Ultimately this week, as Kevin just mentioned, quite a bit of volatility, given the bond auction. Really light economic data week, and next week's going to be really crazy with retail sales. I think in particular in focus, especially given a lot of retailers reporting earnings. But taking a look at some of the comments that Fed Chair Powell made yesterday, I think he's really in a difficult spot. And it speaks to the difficult position a lot of these management teams are in the market right now, where economic data is softening, and it's softening slowly, it's softening predictably. And I think if he were to come out and say something along those lines, we could see financial conditions ease too much. As we saw the 10-year come off that 5% number, move quite a bit lower, basically implying that there's like two cuts that needed to be priced back in. But on the other hand, we still have the economy starting to kind of wade into that swamp, and this is very much a late economic cycle environment. It always looks like a soft landing right before the hard landing picks up. And, I think the insight we'll get next week, especially onto the consumer, should be pretty telling, since it certainly seems like it's beginning to soften quite a bit.
All right. So with that in mind, how do you position a portfolio at this current time?
Yeah, well, on the domestic equity side of things, we still think estimates are too high. If you look at expectations for 2024, 2025 consensus, they're looking for about 12% earnings growth. That's a really difficult thing to do when a lot of the disinflationary pressures that have helped support margins have already come through the income statement. And so where does that margin expansion come from? I think it's going to come from looking at productivity of the labor force. And so, if we think about the route to recession, one of the things that could really trigger that is companies, facing margin squeeze as demand has softened, and we've seen, price cuts really come through. And although volumes have, held up, they haven't from some other companies. And, for full disclosure, we don't own Tesla, but that's kind of been a perfect example, watching the company finally get, operating margins much more similarly aligned with a lot of other auto manufacturer companies. And so, I think as labor is the biggest expense, for companies, we expect to see, management look for some of those savings. And so that means either productivity gains coming from lower wage growth, which is certainly good for the inflation picture, or we start to see the layoffs. And so, looking at S&P 500 industry groups, over the course of this earnings season, about 70% of them have had earnings revisions to the downside. And so it'll be very interesting to see as the year comes to a close just how investor sentiment really starts to shift towards businesses that have durable pricing power. That have opportunities to pull on some levers for margins, and what companies and what industries have already gone through the worst of it, like we think has taken place in a large portion of the healthcare sector.
Yeah, so let's get into that. I know you're watching Thermo Fisher Scientific, Charles River Labs, Agilent. Why is the healthcare sector? It's always known to be more of a defensive play, maybe less volatile in an economic sensitive environment. Tell me a little bit about this group and why you think now might be the time.
Yeah, the healthcare has always had those defensive characteristics to it because, it's fairly unpredictable, when and by, how much we're going to need to rely on certain elements of healthcare. And obviously there's not as much cyclicality with it if you're, on a drug, and, most likely you're going to be on that for quite a long time. And so there's a lot of visibility in earnings, a lot of visibility in growth that we get in this environment. But so within the sector, there's a cohort of tools and diagnostics, the CDOs or contract development and manufacturing organizations that really are the arms dealers for the entire biotech and pharma industry. Over the last 20 years, we've seen an enormous amount of R&D actually shift towards smaller and medium-sized biotech companies with $100 million and less in revenue, as opposed to the big pharma giants that we all know. And in that environment, as we've seen, there's been a lot of outsourcing. So companies, rather than spending capital internally to invest in manufacturing capabilities, they're going to outsource to a company like Charles River, and some of the tools and diagnostics, Thermo Fisher, and as well as Agilent. And so ultimately, since we've had this difficult financing environment, venture's gotten hit really hard. These companies have been conserving cash. They haven't been focusing further in the clinical trials. But that's set to change very soon. We're starting to see some green shoots. It does look like venture capital, bottomed out as far as financing is concerned, in the last quarter. And so, ultimately, these businesses have lots of sticky revenue, lots of reoccurring revenue. They're touching every part of the product, from clinical trials to until the drug goes to generic. And while demand softness may continue to persist here in the near term, these companies have been cutting costs, and we think that the acceleration is really going to come back on pretty quickly.
Yeah, and we'll watch Thermo Fisher, Agilent, Charles River. Thank you so much. Timothy Chubb, great to see you. Gerard,
You too.
a division of Univest Well. Thank you. Have a great weekend. Thanks.